Good morning, everybody. We're really excited to be here, and my name is Michael Kim. I'm the founder of Cendana Capital, and we're going to be talking about the evolution of the seed market. And so for those who don't know Cendana, I started this 10 years ago, and we're actually celebrating our 10th anniversary tomorrow, which we're really excited about. Thank you. But the world's really changed. When I started Cendana, there were probably 10 to 15 seed funds. These were like Mike Maples, Michael Deering, Steve Anderson, and then people like Jeff Clavier, who people were calling him a super angel. And today there's probably over 2,000 seed funds in the US alone. And so that evolution has been really, really interesting. And it's also very remarkable the type of financings that are going on. So back in the day, we looked at our data. Seed funds were doing maybe $1.5 million rounds on 7 to 8 million pre. Today, looking at our portfolio, the average seed round is over 3 million and about 15 to 18 million pre-money. So just looking at our portfolio, our seed funds have gone from, on average, 40 million in size to over 100 million. And when we look at our pre-seed funds, they've actually stayed pretty consistent, around 40 to 50 million. And actually, the distinction between pre-seed and seed funds is very interesting as well. Today, the pre-seed rounds are about 1 million in size and on maybe 6 or 7 posts. And that is exactly where it was back in the day when I started Cendana. So today, I really want to help you understand how this has evolved. We have 3 of our amazing fund managers here. So we're really proud of each one of them. And maybe what we can do is start off by asking each of you to talk about a little bit about yourself, your firm, and actually how you got started in investing and how that's actually different than what it is today.
Hey, everybody. My journey was, I was an operator, so VP of product at Tinder, and I give a ton of credit to AngelList. So when I was first getting started, I was writing $1,000 checks in other people's syndicates, and then one day realized that I could be the syndicate lead, and really just started building one of the biggest syndicates on AngelList. Eventually became a scout for Next Ventures, which was my first managed pool of capital. Focused that entirely on crypto in 2017, so that fund ended up doing quite well. We invested in the seed rounds of Dapper, The Graph, Compound Finance, and some others. And then leaving Tinder, I wanted to start a fund. It was a $10 million fund. I just literally emailed my AngelList syndicate and got my first $1 million, and then was kind of off to the races, and was lucky to partner with you all, obviously. But times have changed since then. That was 2019, and now our team's 7 people big. We're entirely focused on crypto now, and so we've really kind of felt the need to specialize and focus. And I want to find those $6 million pre-seed rounds. I'm not seeing those right now.
Right. And we'll get into that. But also, you raised your second fund already, and I think it's 40 million.
That's right, yeah. We raised 40 and then a $20 million opportunity fund. So
right.
we're at about 60 right now.
Right. And at least when we invested in Chapter 1, I think that was at the end of 2020, right? And then I think you raised your next fund like 6 or 8 months later. So the pacing was relatively quick.
We did. I pride myself. The $10 million fund was a 2-year deployment cycle. So, right now that seems pretty crazy. But we're actually 12% deployed on this current fund, and we're happily behind pace. So hopefully that's a good thing.
Right. Okay, we'll definitely talk about investment pace and all that. Katie, I met Katie probably 3 or 4 years ago. She has an amazing background as an operator and also in the political world. But love to let everyone hear your background.
Hi, everyone. My name is Katie Stanton. I'm the founder and GP of Moxxie Ventures. And my first investment was in 2008, and I was working with Minnie at Google, and I had this friend, Chris Sacca, who was raising a venture fund. I'm like, what's a venture fund? He's like, you give me money, and I'm like, okay. And then it's like 10 years later, 20 years later, you get money back, and I was like, all right, sounds like the biggest scam of the century, but I knew how much he could hustle and how smart he was. And so that was my first investment, which ended up being pretty good. But then fast forward, I was busy as an operator. I was at Google and then Twitter and Color, spent a couple of years working for President Obama. And but it was really when I was at Twitter, I had some girlfriends and we were like, we wanted to do more angel investing. We're like, how come every time you see these cap tables, it's always the same cast of characters? And like, where are the women? Where are the people of color? Where are the operators? And we know there's so much value that this, wider group of people could add. And so we called ourselves hashtag angels. And we did what every VC does. We just kind of announce it on Twitter. We have a blog post. We're like, we're in business. And we were really surprised by the volume of interest. And so that really accelerated my experience as an angel investor. I was lucky to be a scout for Spark Capital because it's a very expensive hobby. and then realizing how much I loved it, I wanted to do this full time and was lucky enough to start Moxxie.
That's great. And also, I think it'd be interesting to talk a little bit about these scout programs, but we'll do that in a minute. And so, Peter, I think we met maybe 2 years ago, and you have a fascinating background, starting all the way in college with Venture. So maybe talk a little bit about that.
Yeah, totally. So I showed up to college thinking I was going to be a physicist and I was going to advance science that way. And I got totally wrecked in my freshman year physics class. And so my plan B became starting one of the hacker communities on campus called Hack Harvard. And then I created the venture capital club on campus called Harvard Ventures. And so I kind of created the mentor network from the venture community, and I had the engineers. And so that's the way that I ended up kind of reinventing myself when I was in college. When I got to my senior year talking about scout programs, I was really fascinated by solving the funding kind of issue. So if you were a student in Boston, there wasn't a coffee shop where you could kind of walk into and get a $25,000 check. That's something that is structurally an incredible advantage in places like Palo Alto. And so I was like, okay, I need to create this for all of my friends. And so started Rough Draft Ventures with the team at General Catalyst with Bilal, who's now at Lux. And I'd gotten to know that team and the other kind of incredible venture investors in Boston. And I feel so lucky to have had so many mentors along the way, like Krisaka and Rob from NextView and so many others. And Katie has been an incredible support. And so I started Rough Draft, this kind of fund for students, when I was in my senior year. That's how I came to join the team at General Catalyst. So I joined a firm that was 35 people. It was 2 offices, headquartered in Boston. I spent 8 years there, so I kind of went from associate to partner. I went from supporting on investments to leading investments. All the while we were scaling Rough Draft, and then this time last year I spun out to build Stellation, which is me as a solo GP, $40 million fund leading pre-seed and seed investments.
That's great. And I think one of the common themes here is that everyone has a different path toward venture and toward your firms. And again, 10 years ago, there weren't really that many scout programs. There weren't angel list rolling funds. There weren't operators with their little side funds. Maybe talk a little bit about how those dynamics have really changed the seed round and pre-seed round, or in Web3. Obviously in crypto and Web3, there are very large pools of capital going after these opportunities early. And so actually, we'll just go after that. Jeff, how do you compete?
Yeah, I think increasingly you're competing with the party round as opposed to like another pre-seed fund. And so to get a $500K check in a round, you have to prove that you're worth all of those angels that they could let in with that allocation. And that becomes a matter of finding a founder who really believes that having more of a stable partner, someone who's there every day, will be valuable as opposed to operators. But it's a real challenge, and I think it's funny because we try and explain that to LPs sometimes and who our competition is, and they really want you to name other funds. And increasingly, I have to say it's this like super angel syndicate of people we're competing against.
Right, and you also mentioned that you brought on like 6 or 7 people to your team. Is that in order to support your companies, or also to help evaluate what's probably more technical than, say, a D2C company?
Yeah, I think in Web3 specifically, the needs of founders are so different, and you're seeing teams built with really lean investment teams and a lot of researchers. So we have 7 people. We have a data scientist on staff. We have an engineer. We have a head of experiments and research. And so it's pretty heavy on trying to identify areas in the ecosystem that other people might be overlooking, and trying to compete, I think, with you look at Paradigm, they have 30 researchers on staff, and so that's kind of upstream what you're competing against. And the DNA of teams is just so different. So we're trying to redefine what that looks like for a seed fund.
Right. And so touching on that in terms of like sourcing, so Katie and Peter, how are you sourcing your deals these days? Is it a little bit different than when it was like 5 years ago or 10 years ago when you started angel investing?
When I started, most of my sourcing was from, many of my operating colleagues. So engineers I work with at Google or Twitter who are starting new things, and that became a very rich source. Now, I think mostly because I'm in this business full time, the best sourcing comes from other founders. We all live in this reputation business. And so if you are helpful, if you are genuine, if you are positive, and you're, positively influencing these companies, founders will have a great experience and then introduce you to their roommates, their colleagues, and other great founders. So, so we continue to reinvest in that type of sourcing.
Yeah, it's definitely changed a lot. So the thing that I would say to also kind of establish the foundation for scout programs is Mark Granovetter's paper on the strength of weak ties. I think is kind of like the fundamental concept that sits behind that. And so I'd taken a class on network theory when I was in college, and that's why part of what helped me kind of think through that having a network of students across campuses was going to be the best way to access the best ideas in dorm rooms. And so my sourcing today is a function of that relationship with students who they started a company, then went and spent 2 years, working in a company, and then all of a sudden, took all of those learnings and want to now start their next company. So that's a fair amount. And then as kind of a compliment to what Katie said, I've actually really loved getting calls from investor friends that I've had trusted relationships with over, 8-10 years. And when I get that call and someone's like, look, I've got an incredible young person, they're going to drop out of Wharton. I told them they can't close the round until you chat with them. That's where being kind of an individual GP, I text back or I call back and I say, I'm going to see that founder later tonight, and they're going to have a decision for me tomorrow. And a lot of that, I think, to Katie's point, is about having those trusted relationships, which takes a lot of time to forge.
One thing that strikes me is that, when Jeff, you talk about your team of 6 or 7, and Katie, you have your partner, and Peter, you're a solo GP, right? How do you guys scale your bandwidth and, to serve your founders?
I'm going to listen to answers, by the way. I'm going to be quiet and listen to answers.
I did my first fund as a solo GP, and so much respect to people who can do that well. I'm married, and I felt like to be a good husband and to be a sane human, I needed to bring on help, because just scaling your time is so hard. And if you are co-leading and leading rounds and trying to invest at the same time, it's truly very hard to do as a solo GP. So. I know it's kind of a buzzy thing within the ecosystem, and I'm personally pretty lukewarm on that being a long-term thing in venture.
So you're alluding to guys like Lockie Groom and Josh Buckley, where they're managing very large pools of capital for institutional LPs. And Lockie's actually on our advisory board, and he's an amazing person. But I always wonder how he scales his time. And so, I'd love to get all of your thoughts on this. Yeah,
Lockie and Josh are buddies, so They're very few Lockies and Joshes, right? A lot of people come into being a solo GP, and that's aspiration. And it's kind of like saying you want to be like an NBA All-Star when not everyone can be on the All-Star team. So I think we'll see a consolidation of solo GPs. We'll see people joining funds merging with solo GP funds. That's where I think it's going.
I might add that venture management is almost like motherhood. You just have to outsource what you can, And for Fund 1, I was a solo GP too, and it's really, really hard. And for Fund 2, we have an outsourced CFO, and now I'm like, I can't imagine my life without her. We have an associate who's doing a lot of sourcing and our investment memo drafting, and it's like, I don't know how I could have left or lived without her too. So just outsourcing what you can, and really, it is a very difficult business to scale. So you have to be very rigorous about how you spend your time.
Right. Peter, are you just listening?
Yeah,
or?
I'm very much living this. So part of what I'm excited about is it's so structurally differentiated and complementary to all of the funds here, and so I'm going to maintain that as long as I can. And part of that's part of what why I wanted to build Stellation in the first place. It's the founder-to-founder kind of speed of interface and relationship is something that is quite special. So I've done a few things. Like I have a dedicated phone number that is just for my portfolio founders. So it's kind of like a bat phone. So it's like I can, text my mom back tomorrow. You know what I mean? But I've got to text a portfolio founder
don't
back
do
later
that.
today.
That's
No,
brilliant.
I talk to my mom all the time. But I've got a separate kind of bat phone for that. So that's been one. Two is I think, and to kind of not have an ego, I think there's an important graduation dynamic that takes place with companies. So I think pre-seed and seed companies have more in common, across that stage than when they start scaling and maturing. So that's where, I think it's exciting to think about these founders then having an incredible stewards that are going to take board seats in the context of the Series A and the Series B that have specialization, that have kind of, broader platform teams. And so I can kind of remain the kind of like the one-to-one, the founder-to-founder kind of, ad hoc text, for anything that you need. And I can always be a resource and a sounding board. But I think I also want to acknowledge the fact that, in 3 years' time, my portfolio could and should be working with, incredible investors here and working with them as kind of the stewards for the scaling chapters that take place after the pre-seed and seed.
Right. And also like thinking about the past 10 years, it used to be founders just wanted to get the best named firm as their investor. And clearly that's changed. People want to work with specific partners. They want to work with specific seed funds and pre-seed funds. And, touching on the solo capitalists, people want to work with Lockyer, want to work with Josh. And so, what exactly from what you see do founders want? Do they want you to help organize their round? And how are they thinking about these rounds? Do they want multi-stage firms in it? Do they want more operators in it? Maybe give a sense to the LPs in the crowd, in the audience here, what these rounds look like today.
Yeah, I think speaking for crypto, the distinction between token rounds and equity rounds is important. But with token rounds, it's really like every fund wants to be a part of those. There's probably 2 or 3 chances to invest in the company. So you see multi-stage funds, everybody's competing at that stage. With equity rounds, it looks more similar to what you'd see in Web 2. And so you do have this concept of pre-seed and seed funds organizing syndicates, and you have more ball control in those situations to work with multi-stage funds.
But these token rounds, are this sort of just like social proof investing? Like if Andreessen comes in, everyone piles in, or
it's a little. I mean, there's so many people who pile in, so it's. I actually don't know how a lot of these funds underwrite the token rounds because your ownership, like by nature, the founders don't want anyone owning a large percentage of the company.
Right.
And so for a $40 million fund, like I can create assumptions that make that math work, but I kind of don't know how that works for multi-stage other than relationship building.
Right.
We're obviously a biased crew, but I would say that most of the best founders that we work with want to work with us because we do have operating experience that can be helpful. So my partner Alex led all of engineering at Twitter, and he's gone from 0 to 100 and knows how to really scale technical teams. And often you have technical founders who are looking for technical mentorship. They don't know who else to ask, and going to a VC who may have worked, in strategic consulting or something else that's important but different. So we try to bring to the table our set of experiences of growing these companies and making our own mistakes and learning from them. And also the horizontal challenge that we see across all of our companies, and you guys probably see this too, it's recruiting and closing top talent. And it's also thinking about, marketing and product and go to market. And again, like we have a lot of these experiences, but also an extended network of people that we know can add value.
Yeah, I think a lot about, to kind of like the frame of your question, Michael, if you take partners out of venture firms and track their performance over time, the performance of the group and the brand changes. And so I look at that as like a little bit of an existence proof that reputation and performance, and it is important to think about firms as collections of individual investing partners. So one of the exercises I like to do with portfolio founders after we close a seed round is to immediately make our wish list of the 15 individuals at firms that we want to start cultivating relationships with, because I do think at the end of the day, you're going to have an individual who's serving as your board director. You get the firepower and the reputation and the cumulative advantage of the overall halo as well. But at the end of the day, you're interfacing with an individual. So that's where I focus a lot on like empathy and relatability, and I feel like that has been so important for forming relationships because if you can interface with 25 different firms and there's more or less a similar kind of availability of capital. I think one of the most important things is to choose a relationship that you feel really excited about, you feel like has alignment, and oftentimes the levels of hunger and alignment are very, very different across firms. So, and certain founders really prioritize that.
Right. And so, Peter, you came from GC, right? And a relatively large firm. Over the past 10 years, I'd say that the multi-stage firms are becoming a lot more active and have dedicated pools of capital to go after seed. So, maybe Katie, when you're looking at an investment that you want to lead, how do you keep ball control, and how do you avoid getting, let's say Sequoia and coming in and taking your deal away?
It's a great question. And I will admit to this group of friends, I made a rookie move in Fund 1 when I was looking at this deal, wanted to invest, and I had a very good friend who was at a multi-stage company. I was doing a background check, and he was like, he's amazing. This founder's great. You should do it. Send a term sheet later that day. I was like, what the heck? And so I'm not going to do that again.
Oh, my God.
So, it has gotten...
Is that General Catalyst? Just kidding.
We'll talk
Michael
later.
Kim.
It wasn't Peter.
That was not me.
It wasn't.
I would never do that.
But it is. It's very competitive out there. And actually, I was very happy with the outcome because I thought it was a perfect lead investor. And at the time, it wasn't the right one for us to lead. But it was a good signal to me to just be very careful. Like, who are we sharing these deals with? Who is the right cast of characters, if you will, to bring to the cap table to really, to ensure the future success of these companies, because you're trying to bring together a diverse set of experiences and people that are really going to legitimately add value. And often founders, especially not to, diss on some of the accelerators, but it's like a shotgun wedding. They're like, you need to tell me by the end of this meeting, are you in or you're not? And you get 0.00% allocation or ownership. And you're like, I don't know. And now you're realizing be patient. We want to be in this for the long term. And we try to encourage our founders to think that way too.
Right. One of the common knocks that seed fund managers make against the multi-stage funds is that, hey, if they come into your seed round and they don't lead their A, that's a negative signal. So, Peter, coming out of GC,
I have so many
how do you
thoughts
think
on
about
this.
that?
Yeah. So being upfront, so I co-led the seed program at GC. So I really enjoyed thinking about these questions for a number of years with Nico and Hemant and the rest of the partnership. And then the second piece is I wrote a paper my senior year on signaling, because that was a conversation that had taken place back in 2012 when you had the first wave of firms like NEA and Andreessen and others doing kind of 500K uncapped notes and then having the conversation around our folks participating in the Series A. At the end of the day, it is going to be driven by performance of the portfolio companies. And in today's environment, portfolio founders very much get to choose who they want as a future partner. And so more often than not, you end up having high levels of competition even for those follow-on financing. So take it, Row is a seed investment that I led when I was at General Catalyst, and another incredible firm came in and was the partner for the Series A, and then General Catalyst came in later on for the Series C. And so I think that's an example of the fact that, even though we didn't lead the Series A, we developed an incredible relation with the founder. And again, I think the reasons for working with a multi-stage firm, number one is developing a relationship with someone that you do feel like can be a potential board director for your portfolio company. Number two, leveraging the scale resources. So if you want functional support in the earlier stages, it's also, why working with a firm like First Round gives so much kind of, leverage and firepower for a portfolio company. You can tap those resources as a seed stage firm and not wait for the Series A and Series B. And then third is, again, there is this kind of reputational cumulative advantage that you have as it pertains to recruiting and closing candidates, and the conception of, there being very natural future long-term capital that makes it easier for hiring a VP of engineering if you need to do that. And you leverage the reputation of the firm. And I also think it's really great to do these investments with one multi-stage firm and then one dedicated, purely aligned seed firm. And it's sometimes tough to make the math
how about
work.
ownership requirement?
Yeah, well, that's what I mean. I was going to say, it's tough to make the math work. But when you do, the founders that are not near-term optimizing, that take 22.5% dilution of that financing, end up owning companies that are worth $15 billion as opposed to $2 billion because they had so much structural leverage, 18 months ahead of time.
Right. All of you guys are very interesting personalities, very well known in the venture world. But I also think of you guys as very disciplined. And so kind of along the lines of where you're looking at a deal and then suddenly it gets away from you because Founder Fund comes in and says, hey, we'll give you 5 on 25 instead of the 3 on 12. So how do you guys maintain this discipline? And ultimately, how wedded do you have to be to your ownership targets? Is it not better to perhaps just be working with the best founders out there?
Yeah, this is happening real time for us, where our average valuation right now is 22, which is on the lower end for the seed market right now for the deals we do. And we're asking ourselves, do we want to compete and stretch and do $2 to $3 million checks and have a more concentrated portfolio? And candidly, if you like to compete and win deals, then sometimes you do that. And so right now, we have a term sheet out where we're doing a $3 million check out of a $40 million fund. So and then you probably just take your first checks and do less reserves, which I think sets you up nicely if you want to raise a larger third fund. But right now, as I mentioned, we're behind pace on deployment. We're 12% deployed, but you can get anxious, and you when you want to win deals, you can make.
It seems like the velocity of investments has slowed down a little bit, just given the turbulence in the markets. Do you see that, or is it still sort of out of control?
It's still pretty damn fast in crypto, and so I would say there's less Series A plus action, preempted after a couple weeks after the seed round, which I saw a lot in Fund of One, but feels like we're going to battle every day when we wake up.
Right. And Katie, how about you? When you're looking at a deal that you love, the founder, you did all the work, you have the syndicate lined up, and then someone comes in and tries to take it away from you. Do you pay up? Do you participate? Even if you can't get your check size that you want?
It's hard. I mean, often I will legitimately think in my head, what would Michael Kim say? I am very lucky that I have, a very disciplined LPAC. I have Michael, I have Jacqueline and Moody at Foundry and Beezer now, all these really smart people who have seen everything over and over and over again. And it's one of the important things I think we can all do as fund managers is to really make sure that we're disciplined. We have, we have a uniqueness to our approach to venture that we're learning from, from others. And, like I see Hunter and Satya here, and they've just done such an amazing job of building Homebrew and really at the forefront of seed, and we learn from one another. And so we can't get too lost in the one that got away. We just really need to be as disciplined, as principled, and as ambitious as we can.
Right. Okay.
I was going to say, I just let it go. I think optimizing for price, tells me a lot about decisioning and a lot about relationship building. And if it's not just about price, if it's about, oh my gosh, we really love this partner, then I try to basically kind of finagle it into kind of like a heads-up deal. And that's where you make the exception. You say, okay, if you really want to work with this firm, we'll do a smaller check. It'll be at a higher price. But the overall company is set up for greater long-term success. And so our smaller percentage ownership today is ultimately going to be in a larger company. And we have to believe that in order to work together.
A lot of this is by dint of very large pools of capital at the later stage coming in earlier, right? And if you can't compete with Sequoia and you're sort of a mid-tier Sand Hill Road firm, you're going to try to go earlier, right? And so, I guess I mentioned that this is our 10th anniversary, and we're actually having an event over the next few days, and we're going to have a panel about what does venture look like in the next 10 years. So I kind of need some answers, and so I'd love to hear what you guys think. I'll tell you my theory, which is, I think firms like Sequoia, Andreessen, Tiger are going to dominate, and they just, aside from having the track record and the resources, I think they're building out serious scaled firms, right? I think Andreessen has 400 people there. And you may think of them as the next Carlyle or Blackstone, where they're really building out different lines of businesses. And then you think about the specialized firms like, say, Ribbit or emergence and focus on specific verticals. And then I think of you guys. You're excellent at what you do. You work very early with the founders and help build those companies. But what about the sort of the middle of the pack? The other thing is that this world is so much more decentralized that if you're a principal or a junior partner at a second or third tier Stand Hill Road firm, you could just leave and start your own firm, right? Yeah. And that is one of the fundamental changes, I think, in the last 10 years. People don't feel like they have to stay at a venture firm and try to claw their way up, while the old guys, because they're usually guys, are clawing onto all the economics, right? So with that, what do you guys think? I mean, what in 10 years from now, who's going to be dominating?
I'll give you my initial thoughts, which is I'm so excited for more 2 and 3 person equal partnerships to be truly dedicated, specialized, kind of aligned and hungry partners at the Series A. So when I think about Mike and Nikhil, from Footwork, when I think about Chris and Jordan from Pace, my anticipation is that from a performance perspective, over the next 10 to 15 years, it's not unreasonable for me to believe that those entities and those partnerships can look like Benchmark, and they can give founders an incredible experience. So that would be number one. So I don't think there's reason to believe that, from a performance perspective, that the existing kind of scaled multi-stage players necessarily retain that piece of the business, because the physics of AUM is structurally moving in a different way. And those firms will be incredible Series B partners. They will be incredible force multipliers for helping companies continue to scale, should they not want to choose to go public sooner. So I think that's number one. And then number two is I do think you're going to have increasing returns to brands and individuals. So I would actually say I think we are going to have more individuals that choose to specialize in certain areas and serve founders in an aligned way. So I think those two things are going to take place.
I would agree. With founders, they have so many choices of where to get capital. Are they going to get capital from Freestyle? Are they going to get it from Homebrew? Are they going to get it from Footwork? Yes, those people are awesome, and they're in this business for the long term. And I do think it's going to be really interesting to see where the next wave of VC talent, are they going to choose to go to the bigger multi-stage firms? Are they going to start their own? Are they going to join some of these smaller, nimbler, awesome teams? So I think there is going to be a shift, and I don't necessarily think the multi-stage firms will dominate, but I'm biased.
Yeah, similar. I love thinking about the barbell venture, and I think you have to specialize if you're doing anything seed-based, and that's what we've done. But there's that great, I think Everett Randall wrote that great article from Founders Fund, showing kind of that middle tier of funds who probably won't be around in 10 years, but we'll see.
Right. Okay, well, we're really out of time. This was a great conversation, so thank you.
Thanks for
and
having
hopefully
us.
everyone in the audience enjoyed it.